You're saying, look, anybody who didn't panic sell this year would have done well, and you should stay invested.
Indeed. I mean, 2020 was a year of opportunities. It was not the best time for the global economy. The pandemic, tore the economies apart. But nevertheless, the stock markets did very, very well. I mean, global equities are up 13%. Asian markets are up more than 20%. The US is up 18%. So, hey, this has been a fantastic year for investors, for brave investors who had embraced risk, who had gone into the markets when the market saw a big sell-off. And so I think what we learned from 2020 is crisis can sometimes present opportunities for investors.
And where are you looking at those opportunities specifically in Asia next year?
Well, within Asia, we're positive on Asia. We've actually upgraded our call on Asia from neutral to overweight for a number of reasons. We think Biden is going to be generally good news for Asia, probably less confrontational relative to Trump on China. China's economy is doing very well, weaker US dollar, positive for Asia. And within Asia, we are positive on three markets, China, Hong Kong, and Singapore. This is where we have our overweights. And I think China, quite clearly, the story is there. I mean, the economy is expected to grow at more than 8% on our forecast for this year. That's going to spill over to some extent on Hong Kong. And in the case of Singapore, I think the attractiveness of the Singapore stock market is really that it offers very interesting, attractive yield. So in a very low interest rate environment, Singapore offers REITs and other blue chip companies that offer you pretty good dividend payouts and good yield.
We've been looking at these record or multi-year highs for a number of indexes, and there's also been this massive momentum into small caps in the US as well. I'm curious to get your thoughts on our MLive question of the day, which is, can this small cap strength sustain its momentum heading into 2021?
Well, I wouldn't be surprised. Essentially, 2020, we've seen a lot of play taking place in the technology space. So tech stocks have, done exceptionally well. But towards the end of 2020, we saw some money rotating out of technology towards what we call cyclical stocks, value stocks. And, some of these small cap companies we talk about here fit into that category because, essentially when we talk about cyclical and value stocks, we are talking about a recovery play because 2021 is a new beginning. Hopefully, we'll see a stronger recovery in the global economies now with the vaccines available. And so, some of these small cap companies which offer a domestic economy play could actually benefit from the recovery story. So yes, I wouldn't be surprised that small caps could have more upside. They will benefit from the economic recovery. But of course, it's not fair to generalize. I think at the end of the day, it really goes down to picking the right sectors and the right stocks.
Vasu, is a reflationary comeback already being priced in? And at the same time, could we get something from left field, such as an inflationary outlook also suddenly becoming on the horizon?
Possible. I think the reflationary story is still playing out. I don't think it's fully priced in. I think the pickup in inflation will take place in 2021, but the markets are not expecting inflation to come roaring back. The economic recovery is going to be gradual. I mean, that's the honesty. I mean, looking ahead, the vaccines will provide hope for economic recovery. It will allow governments to ease restrictions, allow more travel, but this will take place gradually. It will take place gradually as we progress towards 2021, pick up even more steam in 2022. So inflation may pick up a little bit, but we don't see inflation being a big threat. In the US, for example, we still see inflation averaging below 2%. Which is the Fed's target over the next few years. So we don't see inflation as a big headwind for the markets.
And Vasu, I mean, the reason I asked that question is the steepening of the yield curve in the US and steepening elsewhere too, which could be indicative of people having an outside, looking at an outside chance of the return for inflation. Tell me, how does that fit into your bond strategy?
Well, you're right. I mean, the yield curve is steepening. I mean, we have taken our forecast for US 10-year yields up from 0.9% to 1.2% over the next 12 months. So we bumped it up by 30 basis points. But 30 basis points we think is something the markets can absorb. The Fed is going to keep interest rates very accommodative. They're probably going to keep interest rates at the current level till the middle of this decade, in our view. Inflation, as I said earlier, is probably going to average below the Fed's 2% target. So we don't see a big pickup in long bond yields as far as treasuries are concerned. And where we are positive in the bond space is actually the high yield segment. We think that high yield bonds will do fairly well. We have an overweight on that segment of the bond market. Interest rates will stay low. In the low interest rate environment, I think the search for yield will continue. And that's the segment of the market, the high yield corporate bond market, that we are positive on.